the UK, property ownership can be financially rewarding. I'll make no secret about that, but there are associated tax obligations that are complex and are more like a maze. So it's important that you know how to navigate, or you've got somebody who can help you navigate around those rules. Effective tax planning is crucial in my view for property investors, landlords, developers, and if you want to maximize your returns, A, you've got to be compliant, B, you have to know what expenses you can claim. By exploring all these different opportunities in property tax, including allowable costs, ownership structure, the different reliefs, allowances, exemptions, you'll be in a good position to make sure that you are tax efficient, and that is important. And property tax pretty much covers all the taxes in a nutshell: income tax, capital gains tax, inheritance tax, stamp duty, land tax. Pretty much across the board you'll be touched by taxes from the day you start to the day that you end. And most of these taxes obviously have different thresholds and bands, so it's important that you know exactly where you stand. And as an investor or developer, I think you need to understand the fundamentals yourself so that you can ask the right questions and you can plan effectively. If you're a landlord, the primary concern obviously will be income tax if you have property in your own name, and if it's in a company name, obviously it'll be corporation tax. And it's important that you keep up to date with the different tax bands and rates, so that you know exactly what changes are coming and you can plan towards them. A good accountant will help you do this anyway, and will probably manage that for you. Even if they don't tell you, they'll keep on top of it, but it's good to know the basics yourself, just like you've learned other things in the world of property which you probably aren't interested in, but you've learned them, so you're aware of what happens and how it happens. The same applies to property taxation. Now, I'm usually asked, what can I claim as an expense? And the general expenditure, if you have a loan, would be obviously the interest costs, maintenance, repairs, any bills that you pay, insurance, property management fees, advertising costs, any educational costs, any training costs, but there are other costs as well. As long as they are wholly and exclusively for purposes of your property business, you can claim it. But it's important that you keep accurate records, and you keep all your records so you can demonstrate the expenditure if HMRC ever want to check. And it's also important that you stay informed about the different changes in tax rules, so that you know exactly what you can claim, because allowances change, reliefs change. We've seen so many changes from SDLT, Section 24, and capital gains tax, dividends income, and these keep changing on a regular basis. And it's important that you spend a lot of time deciding on the structure of your business, because that may significantly impact how you run your business and the rate of tax that you pay. And the basic different forms of structure are obviously property in your own name, property as a partnership, joint ownership, limited liability partnership, or a limited company. And each one of these has distinct tax implications and benefits, and it's important that you are aware of them and talk to your accountant, and they can help and guide you. Now, generally speaking, individual ownership is usually quite straightforward, but it could lead to you going into the high rate of tax and then paying 40% and possibly 45% depending on your overall income, and that also depends on how much money you need personally. So you need to decide whether a limited company or having property in your own name or a partnership works better for you, and depending on how sophisticated your business is, you might want to use all of those ones, because you could have, let's say, service accommodation, rent to rent, commercial conversions, you might do a bit of deal sourcing, and you might use the different structures for an individual business. If you own property in a limited company, you pay corporation tax on the profits, and that is set at a certain band. It's changed recently. It used to be 20%, and now it's 25%, and then you have the marginal rate depending on how much profit you are making. So again, you need to be aware of those thresholds and plan for your profits and your tax. And obviously, if you're extracting income from a company, then you've got additional taxes to pay, which is obviously income tax, so you're paying twice: once corporation tax, and then on the other side income tax, which could be your salary or dividend. Obviously, if you have a salary, that's an allowable cost, so it will reduce your corporation tax. If it's dividends, they aren't an expense, therefore that will not reduce your corporation tax. And as always, seek professional advice from somebody who can help you with your business structure and understand your overall holistic direction of your business, so that you can plan properly, including obviously the exit. If you're looking to sell a property and it's not your main residence, and it's obviously appreciated in value, you'll have to pay capital gains tax. So it's important again to have a basic understanding of CGT. Then also it's important to understand some of the costs you can claim to reduce your capital gains tax, and to also obviously have an understanding of what the CGT threshold is for the tax-free income. Now if you lived in a property, for the entirety, no tax to pay. If you lived in it for some of the time, then you can claim principal private residence relief on the element that you lived in it for, plus the most recent 9 months. Alongside this, the timing of when to sell a property is important, depending on how many properties you're selling and what other capital gain that you've made in the year. So if you made other capital gains, you may wish to postpone the sale of your property to the next tax year, so you can use 2 years worth of annual exemptions for capital gains tax purposes. As you'll be aware, wear and tear is a thing of the past, and that was replaced by what's known as replacement of domestic items relief, and this allows landlords to claim the cost of replacing their furnishings, appliances, kitchenware, so on, so forth. So something needs to be replaced. If you buy it for the first time, you can't claim it as a cost, and you can't claim it for capital gains tax purposes either, which is quite odd, but that's the way that they've set the rules. Now if you own a building which is of historical importance, then you may qualify for heritage maintenance funds, and that could be an advantage to you. Check that out and make sure you're familiar with it. Additionally, if you have a room in your house that you want to rent out, you can claim rental room relief and earn £7,000 if you're providing a room as furnished accommodation. With all of these things, I think it's pivotal important that you are proactive with your tax planning and you think of things ahead of time, because you can't change the fact after the event. And if you plan properly at the start, you can then efficiently plan for the costs and also what different allowances you can claim. And sometimes you won't be aware of what you can claim, so you need to make sure you speak to an adequately experienced professional who can help you with things such as the cost you can claim, the right ownership structure, the different reliefs, allowances, exemptions, to A, make sure you're compliant, but B, to make sure that you are tax efficient. As always, if you like the video, click like, make sure you subscribe so you get the most fresh content, and any questions, post them below. I will answer every single question personally.